I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards 2 essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these 3 key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
Across the United States, the Federal Reserve, through its Federal Reserve Education Program, helps people understand how the economy works so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college, videos, classroom lessons, online education, publications, and more. These resources are all
Okay, I'm going to have to pause that for now. I'm gonna have to wait until this comes out. I'm waiting for the press conference in 20 minutes. Is this right? 66707 SPY. Yeah, that's right. It just looks weird on my screen. All right. Spy's just chilling here, rejecting VWAP. There's nothing really happening. We got the dot plot. We got some projections projecting one rate cut for 26. It's not all bad, but for now, there's not really much of a reaction. We're gonna have to wait till the press conference. What really matters is what Jerome Powell's gonna say at 11:30, because apparently this is Jerome Powell's second to last meeting or something like that. This is one of Jerome Powell's last few meetings, which is pretty sad, pretty tough because we got Kevin Warsh coming, which Kevin Warsh is on the chopping block for Mr. Trump, and he wants him to cut the rates a lot, and uh, I don't know. It seems kind of going to be like a really volatile transition, and there's some statistic that says that typically, I think there's a statistic where whenever there's a new Fed chair, the market tends to drop 5 or 10%. I don't know the time frame, but I've heard something like that. I'd have to look into it more, but I would be definitely looking out for some volatility. I mean, all the way, already on top of this, oil volatility and macro volatility. So now we're just kind of in a range on the SPY, um, really between 700 and 660. So if we start to slip low there, we're probably gonna, continue this downtrend. If we look on you zoom out to the daily, weekly chart, we're breaking away from the trend. So it's possible that trend change may be possible in the short term, or we could rally, but there's not too much reason for rallying right now. Until there is, it can change very quickly. But right now we're breaking away from some type of structure on the SPY on the weekly chart. So if we go any lower than 660, then we may drop 5%, which is what I was kind of projecting with this oil volatility. And but I was really more so thinking about the VIX over 30. So if the VIX really spikes over 30, then in a couple days around that same print, then the market would drop a few percent. That kind of happened. We got like 2.5% when VIX gapped up over 30, and then that was it. We just right back down to near 20. But this weekly chart on SPY looks pretty weak. It's weakening, that's for sure. It's in a range though. It's not like a downtrend yet, but it's nearing the bottom of the trend, the bottom of the channel. Any channel that we have left on the this recent uptrend from 2025, April 8th, 2025, when we rallied, like, I forget, we rallied like 4-5% in a day or something. It was insane. I remember missing it. I was sitting there just missing the whole trade. Yeah. Weekly chart on SPY looks crazy. That's really all I'm looking at. But we'll see what happens during this FOMC press conference. See how bearish they sound, because that's really the key. How hawkish are they going to sound? That's really it's really a sentiment thing. It's less about like, are they going to cut? Are they going to hike in the future? They're projecting a rate cut. One of them, it could change. That could change to to a hike, which would be, I don't really know what the implications of that would be. It wouldn't be pretty good. It wouldn't be too good. we're already having a credit crunch. So I don't know how it affects liquidity if they were to hike rates. Liquidity is probably already bad. The market's in a peculiar place. The macro's in a peculiar place. I'm just looking to day trade momentum on the chart though. That's what I'm here for. So there's a lot of cool stuff happening. It's interesting, but it's a lot of stuff happening, but really I'm just looking for some opportunity in the market on the chart. Here we go. Still waiting. I just want to hear them talk. I don't want to hear no advertisements. I'm not trying to play that. They hiked before they hiked before the last recession. Yeah, we got to be careful, man. We get Kevin Warsh, and I mean, maybe he's going to cut, and then exuberance will just double up, compounding bullishness. I don't know. There's a lot of bad things that can happen, but then there's a lot of those doors can close and good things happen instantly. And it's like the market is really just a sentiment machine, a massive sentiment machine. Like I could just imagine a lot of things happening in either direction and doors just even opening or closing, which just opens up the ranges of volatility in the market because the amount of transactions and the amount of reaction, which, well, reactions create transactions. So the reaction to the market, the reaction to the news, the reaction to the world in economics or whatever it is, the headlines, the reaction is what triggers transactions. And those transactions, when there's a lot of them and they spread, they're contagious. Possibly when it's in real life, people talk about they're selling, or people talk about this and that. People talk about buying. Whatever it is, it's contagious. And so that's really what it is. It's just like it really reaches as far as it can. With the internet, it's even greater. And it's just it's great. It's great. It's wonderful. The market is we call the market the seventh wonder of the world. I think that's right. The seven, something like that. Six, seventh wonder of the world type shit. Something like that. But it's true. So many facts about the market will blow your mind when you learn, when you truly understand. You wonder why you'll question everything. Gotta gotta follow the money. Yeah, just gap and go sideways every day. We're just riding those SMAs. They're either on the up or on the down. They're either support resistance. They're act like that intraday based on the gap, open and close. Those are the most important levels, the open and close. That's all that matters. Is candle closes, candle opens. That's why pre-market isn't that relevant. Take it off your chart. It's a distraction. I think Apple's got something up their sleeves this year. Apple's gonna surprise people. Well, they already did kind of with the Neo, but the stock didn't really react to that. Even though I heard something like they're projected to sell millions of those laptops. Look at SPY breaking down 665. Oh, down. Okay. Okay. All right. Well, no rate cuts we're gonna see. What do they have to say? Hmm. Something like no cuts in 26, one cut in 27. And there's one idiot who thinks they're gonna hike rates in 27. Who knows? Imagine that. They're all split, dude. They're all split perfectly down the middle. Nobody knows. Nobody knows what they should do. They just want maybe a couple rate cuts in the next couple of years, and hopefully everything works out. If they stay stagnant, not worried about inflation. Even though gas prices are up, it's a temporary lever. leverage or something else. The market looks weak. We'll see if the market dumps after 11:30, and then I don't know what kind of, I don't know. The trade doesn't really look too good. I mean, if it got another rejection, then that would be decent for a trade, but we would need a rejection and then confirmation, and then I would look for late entry. But so far, there's not really much of a reaction. We just rejected the VWAP right around there, and then just kind of right back down towards the low day. No rate cuts for 6 months, something like that. That's right, huh? Still waiting for this. So, well, right here, it's not really much. See if it picks a direction. Okay. Yeah, just two more meetings for Jerome Powell. That's crazy. Including this one or two more? I think that's including this one. I don't know. That's crazy. Okay. Stagflation risk is rising by the day. And stocks can weather it, says Bank of America. Okay, 4 minutes and we're gonna listen to what they got to say. React to it, see what the market reacts, see how the market reacts, and then look for an opportunity. It looks kind of bearish, but what? Bro. Portfolio breaking out, bro. Okay. All right. 2 minutes. See if we get any movement. I don't know, the market seems kind of slow here. Not much of a reaction yet. If anything, I feel like we may get a reaction down to 662 or possibly lower, but that's kind of bearish. I don't think it's that bearish, really. I think they'll try their best to be lighthearted and optimistic, and maybe that shows up in the chart, in the sentiment.
Good afternoon.
Okay.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to
2%.
expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December.
3 foot right here, but I don't like that.
Our monetary policy
Candles
actions are
closing for another
guided by
minute.
our dual mandate to promote maximum employment and stable prices for the
I
American
don't want to
people.
really answer that.
At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 of a percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects
Would've
that the
been a late
appropriate
entry
level
there,
of the
but
federal funds
not
rate will
taking
be
it.
3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Maximum employment, stable prices.
Thank you. Colby Smith of the New York Times.
target
There's been some
inflation rate.
debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're
well, that
well
was it.
aware
Not much of a
of
reaction.
the performance
was
of
very
inflation
small
over the
there. It
last
didn't
few
take you
years and how a series of
Now we got
shocks
questions.
have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into
Ever
this
since COVID,
exercise.
inflation
And we
is-
need to be seeing that to sort of understand that we actually are making progress, because on net, we didn't make progress. And if you look at total inflation, total core inflation, it's about 3%, and some big chunk of that, between a half and 3/4, is actually tariffs, so we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the SEP, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? I'm just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so, there are 19 people, and so 19 reasons, 19 individual submissions, and if you notice, the median didn't change.
Why do we need to
But there was
explain that
actually
COVID
some
brought
movement
inflation?
toward,
Come on.
a
Ask
meaningful
a better
amount of movement toward fewer cuts by people. So
Stop
4 or
worrying about
5
inflation.
people
Look at
went
true
from
inflation. It's
2 to 1,
literally
let's say,
1%.
2 cuts to 1 cut.
We're already at target. We're good.
And each person has individual
We should be asking about oil prices.
stories behind what they want to do. But essentially it is that, the forecast
about
is
oil?
that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to
No, it's
see
not
in the middle of the
happening
year,
at all
progress on tariffs,
It's probably
going through once and then
ready
tariff
to retire.
inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that
It's like a
progress,
whole
then you
era
won't see the rate
going
cut.
away with Powell leaving. It's crazy. I never thought.
Howard.
What do you think? Care about?
Thank you. Howard Schneider with Reuters. It's just to
Reserve.
follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it.
the ones
But,
who killed
that
the
wouldn't
dollar.
be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress
No
that we had hoped
progress, no
for
rate cut.
on core goods.
Yeah, it's
And
obvious.
on tariffs and on the rest of it. So for whatever reason, people did write up their inflation
In other words,
forecast. That
nothing's
will
gonna happen.
certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the
Towards the
economy,
lows.
and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of
We
wealth
dumped to
effects with the
662. I
stock
wanna
market
try to
down,
capture-
in the form
capture
of
some.
gas prices,
662,
diverting spending from other parts of the economy?
So I didn't get the second part of your question.
Well, the consumers are going to be
know if it's really
potentially
gonna-
diverting money to gasoline
Yeah.
from other parts of the economy. There could be a growth shock or a redistribution of spending there. They can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
No real direction.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing.
Yeah.
So, sorry, your question was?
What the staff is saying about, and has said in the past,
Yeah.
about
So there'd be an offset.
offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much of it happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment, and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target, and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision-making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and And now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can,
64.
can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that. Very important.
Nick.
Nick Timmeros, The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers, on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates, or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now is just kind of on that borderline, the higher borderline of restrictive versus not restrictive. We feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically move sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
I don't like this setup.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation. CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable. And, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount,
early
whatever it
entry,
is.
4 minutes and a half till the
0.7,
candle
quarter of a full
closes. What do
percentage
you
point
know?
above 2% for some time.
It's never that
And that's a
confirmation
concern.
at the right
We
time.
need to get back down to
but that's
2%.
okay.
And we need to keep focused on that,
Let
even
this
though we
drop.
do now face some new inflation from energy. So I'd be hard-pressed to say that one of
I'm
them
not
is
looking for an
obviously
early
more at
entry.
risk than the other.
And in the middle of
And
this
if
question,
I may, what happens
not ideal.
if there's no Federal Reserve Chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly
664.
over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that? And to what extent do you think we're in a different place today? Thank you.
We
just of the people.
It's really hard to
That's
say until we
respectable.
see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that
It's
we
nothing
expect to
overly
see
bullish,
with
it's nothing
due to
overly
tariffs
bearish.
that I mentioned.
It's pretty much flat.
I think it's hard to say,
Even
and
those
it will
rise
depend
on
to
the
some extent on
little
the size and duration of the
breakdown right
effects we're
here.
seeing on prices, and it will
I wouldn't
depend a
be too
lot
sure that
on
it's just gonna fall
what
straight
we
to
can see in
662.
inflation
Could
expectations.
fall all the way to 666 or 67.
And just
but
one follow-up, if I may, just on the BLS report that was mentioned briefly there. It
This
doesn't
candle,
seem
for
from the
instance, has 2 minutes
projections
till
or
it
from the
closes.
comments you've made today about the unemployment
easily
rate and
sweep right
focusing
here,
on that,
and
that your
we could bounce
view on the
and
labour market
normalize on the
story,
day.
to a large part being a supply-side story, has
Or we can
changed.
literally waterfall
Despite
into
the
the
quite
close, which is
negative number
possible.
in February,
Maybe
would that
after.
be the right take? And was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that
This candle's going to close at 663.
good number of
That's
people on the
crazy.
committee are concerned about is just the very, very low level
no
of job
entry.
creation.
If this candle closes
If you
at
adjust
663, it's good.
what has been the trend job creation over the past, let's say, 6
Sorry.
months,
This-
if you adjust
the
that for
662
what
put
we think, our
is at
staff
50
thinks
cents.
is the
I could definitely
overstatement
enter
due to
if I'm not-
overcounting,
I'm
effectively
really not
there's
enthused
zero
by
net
this-
job creation in the
about this
private
one right
sector.
here.
But actually, that
I'd
looks
rather
like
sit this out here
that's
and
about
not
what
get
the
swept.
economy needs in terms of
But I do
dealing
like,
with
we're probably
very,
going to go
very
down to
low
662, 663
non-existent,
right
really,
here.
growth in the labor force,
That's what I
which,
think.
of course, we've
I
never
think
had in
662
our
would
history.
work right here.
So you've got a
But
sort
this
of
late
a
entry is kind
zero
of too late. Like, this is like
employment
halfway
growth
down.
equilibrium.
And it's going to
Now,
close in
that's
60 seconds. That's not
balance,
the kind of late
okay,
entry that I want.
but, I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So We look at that, we see it, we get it, and I mean, everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless, it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking into account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
2-minute candle.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So,
Price actions.
We looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support.
That
we already
VWAP
made all the
projection
changes
was nice, though,
to the framework.
for sure.
That was a critical thing.
That would have probably been
we
the
didn't.
ideal trade.
I wish we had been able to do some things, but we didn't.
But that was happening
So
right
maybe
at the
the next
start
year
of
we'll take a look.
right at
I'm
the
sure we
number
will.
release. That would have been not the right
Michael
trade.
McKee from
Should have
Bloomberg
read it.
Television and Radio.
11.
The minutes
See,
show
read
in
it too.
January, some members of the committee wanted to include a 2-sided guidance on policy. Was that
663.
discussed today? And given the rise in the inflation expectations, how much support for a 2-sided policy warning would there be?
So it did come up today. The policy the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks of from higher oil and gas prices?
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you know, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of, you know, of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that you know, we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were like discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But so sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there is tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. You know, when we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's, you know, 1 percentage point above that. So calling that stagflation, it's not, you know, I would reserve the term stagflation for, you know, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, you know, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, you know, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case, we're going to learn a lot because we're going to learn 6 weeks to the day till the next meeting. And, we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is, our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber. Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. You know, it's your opinion at a moment in time, which can change based on events. You know, sometimes very quickly. So it never locks people in. You know, people are more than happy to be proven wrong in either direction. And so I just think we do it. And you know, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But you know, we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, you know, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and you know there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing, and you know what it does for us is, you know, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and you know, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States anywhere in the world, in a market economy, in a democracy, and you'll see, you know, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned and whether or not it will drive up, the cost of food and other goods that really rely on it to
So
move
I think
across the
it's
country.
a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side. And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
That's the meeting there. All right. Hold on a second. I'm pulling something out of here real quick. All right, so slightly bearish, nothing too crazy. Here, I'm just trying to pull this here. No trade here, really. Okay, Jerome Powell on whether he will leave while the investigation is ongoing. I have no intention of leaving the board until the investigation is well and truly over and with transparency and finality. And Jerome Powell on whether he will continue to serve as a governor after his term ends and after the investigation is over. I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. So there's Jerome Powell for you. Good day. Pretty good meeting there for the FOMC, but pretty much muted price action. We got this little bit of a rejection on the VWAP right at the start of the meeting, and we're down 1%, and kind of in between gaps, in between all these weird levels from the past week. So not really much opportunity for this, for the strategy I'm trying to implement with late entry, early exits with my $59 account here. So it's all good. We got some good information about the Fed and what the how they still think the same thing about the dual mandate. It's just a balance, and that they're not really worried about any of the supply shocks and inflation, and everything seems to be on target, basically stagnant, basically a non-event. To be honest, they even said during the meeting that they would have called it off, and this would have been a great meeting to call off and just cancel. There we go, breaking below 663. So yeah, they did say that even though everyone is so separated, there's one person who's advocating for a rate hike in next year, and then everybody else is pretty much on the same note of two rate hikes in the next 2 years or whatever. And so it's basically like they basically said that they would have rather not done the meeting. So the market didn't really do much. No big outsized move, no reactions really, just kind of a little bit of a downtrend here from the earlier part of the day. Okay. No trades really. Nothing. Okay. Okay, well, that's about it right there. Boom. So, yeah, this price action is pretty lame, pretty boring. Nothing really happening here. All right, so let me go ahead and 30 minutes till the market closes. I'm going to go ahead and keep it going, see what happens with the market. Hit 663, still nothing. Not really much momentum in the market today. It's pretty boring. Probably low volume. Uncertainty. I just think it's funny that they said that they considered canceling the event. They considered actually calling off this FOMC event because it's basically a non-event. They didn't really have much to say. No change rate cuts again for the third meeting. That's pretty funny. I never said that before. Down 1.15%. SPX, NASDAQ down, same. Dow Jones down 1.5%. Well, the way the charts are here is the same reason why I didn't get on at the open, because we just gapped down. Not really much of a good look, to be honest, for my strategy. And it's probably better to wait for the volatility to come in around 11 or around 2 p.m. Eastern when the meeting started. But we didn't really get much momentum. We got a little bit of a downtrend, but nothing really for me to capitalize on. But I think it was a decent meeting. I mean, I like to hear about Jerome Powell's thoughts about the institution and, you know, his, you know, potential retirement or whatever he said that hasn't decided, and he's considering the needs of the people they serve, which is highly respectable. So that was good to hear, and I had to post about that. But the price action really gave no good opportunity. We'll see. Tomorrow is Thursday. I don't think there's really any significant earnings tomorrow. But we're in this range, so range-bound market makes for a little bit more difficult trading. I think tomorrow I'd probably get on at the open and look for something like an opening range break on the 30-minute hourly range break. Look for something like that, in confluence with the VWAP or whatever. I don't think there's any trades here. It's 20 minutes, 25 minutes till close. SPY on track for a third consecutive weekly close below the 20-week moving average. That weekly chart is, yeah, the main concern right now. That's the trend change I was talking about. It's just a inkling of a trend change on the weekly chart that we keep getting these little downtrends. We gap up and then we just sell it off. Now we're rounding out. We'll see if we do go lower, then, you know, there's definitely more opportunity if we can break this range a little bit. The VIX is still elevated at 24, so it could definitely keep spiking at any point. They said uncertainty like over 50 times during the meeting apparently, so, you know, if uncertainty's the key factor that's lingering, then, you know, that means that it's more likely for us to sell off, have a little bit of a correction here with all the other things happening. So just kind of leaning in that direction, you know, in the short term. Oh, wow. Live? Okay, cool. Wait. What was that again? Oh no, Jensen. I think Jensen was Jensen on with Jim Cramer yesterday, I think. That's crazy. Yep. Jensen Huang went on Mad Money with Jim Cramer last night. The market's down 1.1% today, 1.2%. Oh no. What about Nvidia specifically? It's down 0.5%. MU's up 1.1% though. They posted earnings and they're doing some interesting stuff. MU is a sleeper. Even Intel's up today, I think. AMD. Intel's up 3% today, actually. So, it's good there. AMD's up 1.5%. But Nvidia down 0.5% after going on Jim Cramer last night. That's weird, huh? Nvidia said it's going to post $1 trillion of revenue between now and 2027. And they also said that Nvidia to return 50% of free cash flow to investors through dividends and buybacks. That's insane. And their stock's already technically undervalued. They have like a 20 PE. And with that kind of projections, it's crazy that they're down today. It's totally crazy. The Fed should have hiked rates today. No. Maybe next time. All right, 662. Here's the level. Sometimes I convince myself to take a small profit and the risk of position, exposing myself to much more risk later, especially given the fact that I have a small account. Taking a small profit doesn't move the needle. But taking a small profit now exposes you to more risk later. Exposing yourself to more risk now allows you the opportunity to capitalize on bigger opportunity and profit more, skewing the odds in your favor. This is the concept of risk that needs to be understood in order to be successful as a trader, even as an investor. Maybe if you have a big account, taking a small profit would make sense, but if you have a small account, taking a small profit doesn't necessarily make sense if you're trying to actually make money and gain momentum. Sure, testing your strategy through consistency and determining your edge by repeating actions over time can bring you results and show you which direction you should go, but it won't actually increase the numbers in your account. Finding the right opportunities to take bigger risk on and sitting out the opportunities entirely where you would take less risk is where you'll find the most meaning in the market. You owe it to yourself to be patient for the right opportunity, to be patient, and for when that opportunity comes, you owe it to yourself to take the risk. And not only to take the risk, but to reap the reward sooner than later. So patience is really just the only way to capitalize. The risk has to be defined. You have to be discerning. And with the $50 account, or a small account in general, even a $1,000 account, you have to be extremely discerning. So, yeah, and winning feels important, but it's really just your ego in disguise. Most traders chase wins because they feed identity and validation. The deepest truth in markets is asymmetric. Not every losing trade carries meaningful value. A lot of the time you're just taking a trade because you want to and you have the urge to. But that has no meaning and no signal. It adds noise to the total of your strategy, your edge, and it ruins it. Not winning every trade proves nothing. The real edge lives in a narrow subset. So if you overweight victories, even random victories, and you rationalize defeats, even instructive ones, this emotionally distorts reality and your edge. Markets don't grade your effort or intelligence directly. They pay for your alignment with future action. They pay for your patience, just like Warren Buffett says that wealth is transferred in the markets from the impatient to the patient. And that's mostly for investors, but as a trader, it holds the same weight in terms of your discernment. Most losses are noise. A stop hit because you misread the momentum or enter too early, faded a news spike without edge, or you size too much. That's your tuition. You have to pay that as an accounting fee for making a poor choice. You pay to participate. treating every loss as a lesson inflates your ego and your need to be right retrospectively. It can teach you something, but it turns random noise into false narratives. Real learning is actually selective and discerning. Rare asymmetric wins matter. Only trades that compound over time are few. Where you took a non-consensus view and proved right, your reasoning was sound and falsifiable. The market moved decisively in your direction, where you sized appropriately and you let your winner run. That's very important. That's probably the most important. To size appropriately and let your winner run. Let your trades speak for themselves. And that's a skill in itself, and that's a whole different thing. But these are the trades where you were right and almost no one else was. And you capitalize on that asymmetry. That teaches you pattern recognition, timing, courage, and position management far more than any string of small losses could. So, because markets are efficient, views and news gets priced in quickly. So edge is rare. That edge being rare means patience, in a sense. But when it appears violently. Crowd theory, liquidity cascading, narrative flipping. These are things that are highly relevant. A single correct non-consensus call, properly sized and managed, can return 5-10 times more than any other strategy at the end of the day. Taking dozens of normal trades with a 1-to-1 or 2-to-1, it's pointless. I mean, until you scale up to a certain point where that consistency becomes so boring. But there's levels to it. Protect capital ruthlessly, wait patiently for high conviction setups, extract maximum value when the rare alignment arrives. The asymmetry. Any high uncertainty career is one where you should detach your identity from the scoreboard, detach your identity from the outcome. You anchor your process to systematic integrity and patient, rare asymmetric correctness. This is not a game for everyone, this is a game for the few. In a high uncertainty domain, winning isn't the goal. Being right when it's hardest to be and most valuable to be right is the goal. So, your level of complexity of understanding the markets and everything outside of it plays a large factor into your intuition and your ability to read price action, because price action mostly is noise. And that's why a lot of the time I may be quiet, and when I'm looking at the chart, it's pretty boring. Price action is mostly noise. It's all sentiment. Sentiment only matters when those in between phases or in changing phases. Protect capital. Stock high quality trades, setups, and take the risk when it materializes and receive what the market is willing to give. A handful of trades defines careers. The rest is overhead. And patience, once again, is a virtue. Berkshire Hathaway and Warren Buffett is a short story about how Buffett is regarded as one of the greatest investors. But he openly calls some of his decisions his biggest regrets. in buying Berkshire Hathaway itself. In the 60s, he was buying shares in what was a failing textile company, initially as a cheap cigar butt play, expecting liquidation profits. He later gained control, but stubbornly kept the dying textile business running for years out of spite, after management tried to shortchange him. He has said that this single mistake cost him around $200 billion in opportunity cost, which is what Berkshire could have earned if he had deployed capital somewhere else sooner. The opportunity cost. ConocoPhillips, at peak oil prices 2008, invested heavily right before the financial crisis in the oil price crash, leading to big paper losses. He later called it a timing disaster. It's from Buffett. Other regrets include missing its early stakes in Amazon, Google, and investing in the U.S. Airways airline, which burned him in the late 80s. Even value investing legends can fall for emotional decisions or macro misjudgments. Five minutes till the market closes. I don't think I've shared this one. Well, we got down to stick 61.37 and still doing basically nothing. It's not really much movement. Gotta go get some lunch, honestly. Pretty hungry. Stomach hurt. Going down closer to 661, below 662. It's getting a little rough. Looks like we may be going a little lower. The next level is going to be 657. 660 and 657, and It's going to be a range from 660 and 652. Probably won't gap down though. I don't think we're just going to gap down. Maybe sell off tomorrow. That's funny. Well, we're gonna have to wait till tomorrow. See you at the open. We'll look for some volatility tomorrow. Looking pretty bearish though. Uncertainty in the air. That's the thing. That's what's happening. That's all you need to know. Uncertainty is in the air right now. That's it. Okay, there's the market close. Down 1.3%. VIX up almost 10%. Alright. I'm gonna go get some lunch and I'll try to be on in the morning. See if should be an opportunity tomorrow, hopefully. We gotta take a trade soon, so have a good rest of the day. See you tomorrow.